Hi, Jim. This is Matt in Minnesota. I have a quick question about 1099 income. I'm a W-2 employee in the highest tax bracket, in a high tax state. I max out all my tax deferred space in my retirement accounts. And this year I started doing some consulting that I anticipate will probably bring in a low to mid five-figure sum. Traditionally, I've heard you talk about opening solo 401k for a contribution of up to 20% as an employer contribution. However, on a recent podcast, you mentioned something about customizing the solo 401k plan to allow for mega backdoor Roth contribution of the full after-tax amount. Can you talk a little bit more about that and sort of the implications of that and the costs involved with setting up that plan and when it's worth it from a perspective of how much you're making? And alternatively, for a first year with 1099 income, how do you determine estimated quarterly payments or a safe harbor? And is it safe to simply determine the tax at the end of the year if there is no pre-existing 1099 income from prior years? Thanks for any of your input. It'd be very helpful to have some of your insight.
Okay, lots of questions there. The first one, though, is best answered by that page I used as a sponsor for this episode. If you go to whitecoatinvestor.com/retirement accounts, you will see lists of providers. There's a list of people that set up 401ks and other retirement plans for your practice, you and your employees. There is a list of self-directed and customized solo 401k providers. And there's a list of cookie cutter or standard solo 401k providers. The cookie cutter ones, the Vanguards, the Fidelities, etc. They're not customized. They're not self-directed. You can't invest them in Bitcoin and gold and real estate and syndications and that sort of stuff. You have to have a customized, self-directed one for that. And I say customized and self-directed. Those don't necessarily have to go together, but they usually do. Is that worth doing? Well, one big advantage of having a customized one is you can have the rules put in it that allow you to do a mega backdoor Roth IRA. And at your level of 1099 income, that makes a big difference in how much you can contribute. Let's say you make 50 grand in 1099 income. If you do that as a regular employer contribution, you can only put in $10,000, right? It's 20% of your net self-employment income. But if you did it as a mega backdoor Roth IRA contribution, you could put in all 50 grand. So that's the benefit. Yeah, it's going to cost you something. It's going to cost you a few $100s to set that up. It's going to cost you a few $100s a year to keep it going. But you got to defer 50 grand, right? That's a lot more than 10 grand. So someone in your situation, it may be worth doing. That's where you would go to set that up. Your other question was about quarterly estimated payments. And the way to think about this is to keep in mind that there are two separate things going on. One is you have to pay taxes, okay? And it's a certain amount each year. You really don't figure out exactly what it is, but it's supposed to be a pay-as-you-go system. You pay taxes along as you go. And then come April, you settle up with whatever your tax bill actually is. And you might have to write a check. You might get a tax refund. And that's totally separate. The amount of tax that you owe is totally separate from what you pay as you go along, from what's withheld and from what you make as quarterly estimated payments. Those are not the same amounts. That's why you have to settle up every April 15th. And so what you're doing here with quarterly estimated payments is you're recognizing that you have additional income for which nobody is withholding tax for you. It's supposed to be a pay-as-you-go system, right? If you don't pay as you go, you could get penalized. Now, you don't get thrown in jail or something. You just got to pay some interest on it. It's not a big deal. But if you want to avoid doing that, you pay as you go. So what the first thing people do when they have a little bit of 1099 income is they just decrease they increase how much is withheld at their W-2 job. If you make $8 grand in 1099 work, you can do that and you can cover the tax bill, no problem, right? But if you make $250,000 at your 1099 gig, that's not going to work. You can't withhold enough from that W-2 gig to cover that tax bill. And so what you have to do is start making quarterly estimated payments. And this is really hard. It's hard to get them right. It's fine if you don't get it right because you're going to settle up next April 15th. If you didn't pay enough, you'll pay a little bit of interest. Not a big deal. but it does cost you some interest you didn't have to pay, as long as you have the tax money. The bigger problem for doctors is they don't set anything aside for taxes, right? So when you're making 1099 money, you ought to assume that something like 25 or 30% of that is going to go to the tax man. So if you have to, take that out and set it in a separate savings account so it's there come April 15th so you can actually pay the taxes, or so it's there when you make your quarterly estimated payments. But the easy way to make quarterly estimated payments is take a guess at what you think you're going to owe for the year, divide it by 4, send that in each quarter. And remember that it's not like real quarters. It's on April 15th, and then 2 months later on June 15th, then 3 months later on September 15th, and then 4 months later on January 15th. So the hard one for me is always June 15th because I've only had 2 months to save up for it. But that's when you send those in. Okay? You're trying to get in the safe harbor. If you're in the safe harbor, you don't have to pay that any interest or penalties or anything for underpaying as you go along. And the easiest way to be in the safe harbor, if you're all 1099, is to figure out what your tax bill was last year, right? Multiply it by 110%. This is for high earners. You only have to multiply it by 100% if you're not a high earner. And then divide it by 4 and pay that each quarter. But if you have W-2 income and you also have this 1099 income, it's really hard. You're guessing. And the only way to know for sure is to project out your taxes and know what your income is going to be. And lots of us don't. This is incredibly difficult for me every year. I'm trying to guess what to do for my quarterly estimates. Okay. Last year, I totally missed. And so I have this massive tax refund coming. I have basically loaned hundreds of thousands of dollars to the government that I should not have done so. And so sometimes you just blow it. It's just not that easy. I didn't know what I was going to make. I didn't know the business was going to do. I didn't know about some investments that were going to pay off. I didn't know about some income that was going to be pushed. I guessed on how much my quarterlies were going to be. I paid way too much in quarterlies. And so I'm getting a whole bunch of it back. And that's fine. I give the government a interest-free loan. It's not the end of the world, but it's ideal not to do that if you can avoid it. And so do the best you can. The first year, they do give you a little bit of leniency, but I wouldn't count on that. I'd try to comply with the law. Just remember the basic principles. You have to pay taxes. It's a pay-as-you-go system for the feds. Not all states are that way. Utah isn't that way. But for the feds, it's a pay-as-you-go system. So if you're making any significant amount, and I'd say significance more than 20 grand in 1099 income, plan to start making quarterly estimated payments.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.